Thank you so much, Dominic. Finally, we've got Carlos Hardenberg, who co-founded Mobius. Oops, sorry. Who co-founded Mobius Capital Partners alongside emerging markets legend Mark Mobius, who's the manager behind Mobius Investment Trust.
Thank you. The good news is that my previous speakers did such a good job in telling you why it's the perfect time to buy emerging markets. I can just focus on convincing you to buy us. So I'm not going to use all of my time, but hopefully there's a little bit of an interesting bit left. My name is Carlos. I've been working for Franklin Resources for about 20 years. I had the great pleasure to be in, I guess, your second home country, Vietnam, also since the late 90s. And after 20 years working for a very large fund, we decided to set up a very small fund to focus on what we think the best ideas are in emerging markets right now. Very concentrated investing, very proactive investing. We have a incredibly high active share, so we do not. We were actually not invited to the celebration of MSCI's 35th birthday because we have no overlap whatsoever. So the active share is 98% now. And the mission really is to find ideas which are not discovered yet. Vietnam is certainly one very interesting area to do such thing, but there are many, many areas in emerging markets which are not so well covered. And actually, just to put things into context, there are almost 40,000 listed companies in the region. Our focus is on the market cap spectrum, which is slightly smaller, 500 to 10 billion. The average in emerging markets right now, which is to some people very surprising, is over 100 billion in market cap. So they have really grown up. But what we think the most exciting parts are actually the smaller, more nimble companies, which are backed by entrepreneurs, which are a lot more sort of innovative, which are a lot faster, and which by now attract the smarter brains in emerging markets. So if you speak to the typical 20-year-old, 22-year-old in emerging markets, whether it's in Vietnam or whether it's in Peru, in Brazil, in Turkey, and you ask them, do you want to work for Goldman Sachs or the local Goldman Sachs, or do you want to work for a startup or a small firm? In 9 out of 10 cases, the answer is, I'm more interested in small enterprises. So that's why this brain drain is coming into the favor of the smaller companies. Our focus is on minimum 1 million turnover, and we exclude certain sectors. My mentor in investing continues to be Sir John Templeton, although I don't work anymore for the firm, but he called it sin stocks. This is pre-ESG, and that was weapons, pornography, fossil fuel. So we exclude all of this. And also a big difference between us and some of the previous presentations we heard is we avoid state-owned enterprises completely, and we also avoid, as I said, benchmark completely. So we are truly trying to find outside of the benchmark. In terms of the results, so one of the very, very wise things John Templeton said is if you want different results, you have to invest differently. So the 98% active share means that there is no overlap. We have a concentrated portfolio, 26 stocks, only one in Vietnam. I'd love to have maybe a second or third one, but we're struggling a little bit at the moment. The returns have been very pleasing. The benchmark returned negative, minus 4%, and we generated by today actually 36% over the same period. We're just about to celebrate our 5th anniversary. And the focus and the recipe is really to focus on profitable businesses which have a solid capital structure, so ideally no debt, and we do proactively engage with companies. I've got 2 colleagues of mine here with me today. They can soon write a book about engagement. And engagement to us means to improve or help these companies, incentivize these companies, push these companies to improve governance. A huge issue in Vietnam, certainly. But that means better transparency, cleaner annual reports, That means not having just cousins and brothers and sisters on the board, but maybe independent and professional board members. Those type of things we do, and we've appointed 80 board members in emerging markets. What is also important as a risk policy that we do not compromise is that we look at obviously competitive advantages. We look at industries which are growing, where profit pools are growing and not declining. We're radical about this. Growing profits and dividends. And then probably most importantly, and this is where we struggle a bit in Vietnam, is to understand the corporate culture. What is the corporate culture all about? And do they really, is it sustainable? Do they have an ESOP system? Do they really care about, hiring the right people? Do they have an independent board of professionals? So all of this is a part of the culture. We've actually sponsored a study with the University of Chicago 2 years ago, examining the relationship between corporate culture and stock market performance in emerging markets. And happy to share that with any one of you. It's quite an interesting study with, of course, the desired outcome for us, showing that we are all focusing on DCFs. We are all focusing on annual reports, which is very important, I think, but we're just focusing on the numerical part of the business without really understanding what is happening inside the business. And having worked for a large organization, I experienced this myself, how important it was to understand really the culture and the inner dealings of a business. And that's something which we try. We don't have the magic formula, but it's something where we focus a lot on understanding the culture of businesses. Then, of course, focusing on engagement opportunities, which doesn't mean we're trying to pick bad companies, but we're actually trying to pick companies which are on the right track. A good example, again, I'm taking a leaf out of your book, Vietnam. So a business like Vietnam Milk, which hasn't done so well, but nonetheless, they are moving up the governance curve extremely steeply, and they're really investing into improving their governance. So that's sort of something we like to see. And then, of course, brands and a loyal customer base. But what we're really looking for is innovation and technology. So, for example, if you think about autonomous driving, satellite technology, if you think about the transition in Europe now to wind and solar, which we all, I think, understand, and we see what's going on. You just have to fly from continental Europe to the UK and look into the ocean, see what's happening there. Who's really winning? Who is benefiting the most from these developments? And these are companies which are in Asia, predominantly in Southeast Asia, and they came up with solutions supporting these industrial transition processes. I'm talking about sensor technology, highly specialized businesses which focus on certain materials which are used, high performance materials used in these devices, but also software around it supporting some of that, as I said, factory automation or smart homes, where a lot of these components, a lot of the software, a lot of the specialty parts are developed in Asia. Example, there is, if you just walk into, for example, an electronics store here, forgot what they're called here, the large electronic retailers, or actually you can walk into Tesco and look at the price tags. They are by now, and this was also helped by inflation, where prices needed to adjust more rapidly, they're moving into electronic paper, which is called e-ink. And e-ink is a technology which is dominated by one small company which founded this idea. Actually, the founder went to a US university. He came up with this idea. He patented this globally, and he's the only guy who can produce this technology. It's also to be found in Amazon Kindle. You can go to Burger King and look at these indoor signs. It's all based on on this same technology. And it's still a company not in the benchmark, not really well known in the world. They're produced globally, and they are completely protected. They recently came out with a color-based e-ink technology. So these type of businesses, which have a deep moat and which can scale up and sell and compete globally. What we certainly don't like, and this is why we also exclude a lot of the benchmark names, is companies which have reached the peak and which matured, Alibaba, Tencent, all these. I would even be skeptical about TSMC. I think there's very little we can add in terms of driving value out of this or driving alpha out of this business, where 50 analysts are covering this. But telecom, banking, we don't like banks. I think banks are there to be killed by competition, by my children who are now joining fintech businesses, who are constantly, they're just thinking about how do I steal their clients and how can I innovate technology to steal their business, which as a banking client myself should be quite easy because what they do is still quite lousy. And then, of course, we do not like unsustainable capital structures. We also don't like difficult macro environments. We have not invested in Russia. We had 0 basis points exposed to Russia in February when the war broke out. We don't have anything in Argentina. We don't have anything. I saw Pakistan earlier here. So many of the frontier markets we are avoiding simply because of the external risks. So I think I covered most of this. What makes us different, we're really small, we're tiny. We focus on a single strategy. We are still managing less than $1 billion. Our capacity is also not that large. Our capacity is around $1.5 billion. We have a strong network, concentrated portfolio. Big difference is also that we have a lot of our own savings invested in the strategy. Over 40 million is coming from ourselves. And we're really passionate about due diligence. Now that has delivered decent returns since we started. Yes, volatile as expected, and I think it's going to stay volatile. But you can generate outsized returns if you back the right businesses and if you search very carefully and if you have the right policy on risk-taking as well. Now, this is probably more difficult to read, but we've outperformed the benchmark, which is negative by 35%. And also we are showing the mid-cap index, which has done far better, but we also outperformed this by almost 20% since we started the strategy. Now, how did we do this? Bottom up, very careful stock selection, a little bit of frontiers in here. You can see Dominic here, Vietnam. We don't leave you alone. So we're also backing Vietnam a little bit. We have a stock in Kenya, but the rest is really Asia focused. So, like different Asia than Vietnam. 75% is in Asia. Taiwan, India has been growing substantially. We've got a fantastic colleague who sits in India for us. She worked for the largest PE fund in India for many years and has been helping us to navigate towards the 4,000 listed small and mid-cap stocks without investing in any of the known benchmark names, obviously. South Korea, to me, is the better China. I would disagree slightly with you on that. And I also find the export opportunity particularly interesting because of the competitiveness of South Korean products and services. And if you know China and travel in China and speak to Chinese friends over dinner, I always compare this to how they think about South Korea is quite similar to how Europe used to think about made in West Germany. So they're very keen on South Korean products, services, music, food, fashion, anything South Korea is sexy. So South Korea, if you pick the right companies, and if you especially pick family-backed businesses who are successful in China, you get less governance risk, and you get actually sort of a bit like this Louis Vuitton way of getting exposure to China. And then we actually have 0 in China directly. We have a bit in Hong Kong here. Taiwan, a touchy issue. We have not invested in TSMC. We have not invested in any of the large Taiwanese businesses, but instead we invested in smaller niche businesses which are listed in Taiwan, but which are actually doing business globally. Some people have mentioned that this is sort of almost like investing in Apple. Of course, a lot of them are doing business with Apple. They are focusing on, for example, screen technologies, as I said, sensor technology, signaling technology. But the single largest exposure we have is encryption technology. And the encryption technology is globally needed, whether it's public sector infrastructure, whether it's private sector infrastructure, whether it's our devices, whether it's anything. We need to make sure that the systems we're building are safe. And the business we've invested in out of Taiwan is the world's leading number one, actually, developer of encryption technology. They supply to TSMC, but they're still relatively small. And every night at around 6 o'clock in the evening, all of their assets walk home. So it's just a people's-based business. They are smart engineers who are constantly coming up with basically technology which they put on paper. They develop these models which are then sold to the large OEMs. So technology plays a huge role here. 60% of what we do is technology, but it's quite diversified. Software, semiconductors, hardware. Semiconductors, we do not have the foundries. We've got the testing businesses. I don't know which chip is going to win, but I know every chip needs to be tested. Every single chip on this planet needs to be tested before it's shipped. So that's why we quite like this more defensive part of the industry. These are the top 10 holdings. Not sure if you can read this, but I wouldn't be surprised. None of them are really known to most investors. The weight are quite punchy, so the top 10 holdings make up more than half, and the market cap ranges between 14 billion and 500 million. So that's our sweet spot. They are just about to recover from COVID. The EPS growth expectation for next year is very, very decent, very strong. So we are quite optimistic that this earnings growth will also translate in an ongoing re-rating as these companies continue to be very attractively valued. This is us. So focus on around 3 billion market cap, benchmark much higher, very, very profitable businesses, very high margin businesses, very high return on equities and return on assets, and of course, a net cash. So these businesses are not dependent on financing their growth from expensive bank loans. In terms of valuations, still very reasonable compared to the US. We heard about this. Just one example before, to take maybe just a few more minutes. Persistent Systems is an ideal example of what we're trying to find. This is a company, I would say maybe 30% of the companies we've invested in have been founded by emerging market entrepreneurs who studied in the US. So they either studied on the West Coast and some of those very good universities, or East Coast, and were highly trained, highly educated, went back to their home country and established a business. And similar with Persistent Systems, this is an Indian technology company. They offer digital engineering solutions. They work with companies all over the world. We started to talk to them back in 2018, 2019. This was still a stock which was less than $1 billion in market cap, but we saw that the founder had the right drive. He focused on few verticals, factory automation, but also healthcare, so hospitals and software programs supporting hospital systems. Of course, he benefited from an infinite pool of talent in India and very good relationships in the US. So he built this business, attracted the right people. It performed extremely well. It's about 5x since we bought this business, continues to really do well. It is the company in India with the single highest percentage of inclusion of employees in the employee share option scheme. So over 80% of staff are shareholders of the business. And that's why he has a very, very low attrition rate. So people tend to stay. People are very loyal. And they're going even further. So a lot of them have programs whereby they use a part of their salary to purchase more shares in the business. So that's what I call alignment of interest. Park Systems is another example. Just coincidentally, this guy also studied in Stanford as a Korean guy, graduated in the 80s. Is it right? Late, mid-80s. He was focusing on something which I found difficult to even pronounce. It's called atomic force microscopy. Now slowly I begin to understand what this is all about. This guy, by the way, didn't know what it was all about when he was studying it. He was just a very keen scientist. And he certainly also didn't know that this would have such a huge industrial and commercial application. He developed microscopes with his professor in Stanford, went back to Korea, built this little entity, this little private enterprise, And by now, he is the #1 producer globally of atomic force microscopy, which used to be used in like labs and in the biochemistry industry. But now, if you, many of you will know ASML in Holland and the ultraviolet lithography, these systems which are necessary to produce 5 and 7 nanometer microchips. And if you then try to understand how these ultra small processors are being tested, can be tested, then the answer is only with atomic force microscopy. So suddenly these devices are needed by everyone who's in semiconductors, and he is the #1. So we like the moat, very difficult to compete, very difficult to come up with something like this, also because it's all patented globally. So still small, 800 million market cap, growing very, very rapidly. The addressable market is growing. And we had the chance to build this position recently, not too long ago. The market size is going to grow by 10 times in the next 10 years. So quite exciting opportunities if you really dig a little bit more into the thickness of the offering. We talked about this. I don't think I can do a better job than my colleagues. I think the discount in emerging market right now is something we are enjoying a lot. This is an absolute paradise for someone who's ultimately trained by fundamentals. And I think valuations always play a role, and we need to understand them. But this is a good time to buy quality assets at a time where there's abundant pessimism flooded in the street. There will be a time where we will look back and say, gosh, this was a fantastic opportunity. The market just got too negative. If you just focus on some of the fundamentals, estimated earnings growth for the next 3 to 5 years. The portfolio is expecting to grow by around 17%, the index by around 12%. So we are talking about a substantial recovery in earnings growth, of course, partially helped by about 4 billion Asian individuals who are beginning to consume in a more normalized way. And then in terms of returns calculated, the highest returns estimated annual equity market return over the next 10 years, according to the Morningstar studies. Of course, Brazil, China, South Korea, these are the exciting markets compared to the US. Now, engagement matters. We are actually just about starting a new study sponsored with some researchers on engagement and active investing. But I have no doubt in my mind that it plays a huge role, and to us internally it plays a huge role because it gives us a handle on risk management. If you engage with companies, you get a better understanding of what can go wrong when you invest in some of these businesses. And some of the highlights, as you can see, this is our work. Most of it is on governance. Some of it is in culture, capital allocation, environmental issues, and we engage very intensively with our portfolio companies. We also visit them. This was recently in India, where I spent a lot of time looking at some of these mid-cap businesses. And of course, I also don't ignore tourism. So I had a fantastic visit here. After the visit, I went back home, and my eldest son just graduated, and I told him, you have to go to India tomorrow to see the world, see what's happening. My children were all born and raised in Turkey, so they do know what an EM is, but I sent him to India for a month, and then it's always the budget discussion. And I said, your budget for this trip is €6 a day. He and his mother, my wife, almost killed me on the spot, but I stuck to my thesis, and he just returned now after a month, and he said, Papi, I have still some money left. So you don't need much money to have a good time in India. But actually, the little anecdote here shows that it's still really early days in this country. And there's the atmosphere in India, the kind of spirit you get when you talk to entrepreneurs. And I've been going to India for 25 years. I've never experienced it in this way as it is now. They're all very optimistic. They're all looking positively towards their own future. And I've also never seen such substantial investments taking place in India. It's used to be a lot of talk, and now it's really happening. So I'm looking forward to participating in that over the coming years. That is it. Thank you very much. I told you I need a bit less time.
Thank you to all our speakers for a really fascinating afternoon. As I promised, lots of different diverging views. Myself, I don't think I'll be able to look at a map of China without thinking about the 2.6 billion armpits. If you'd all like to join us for a drink, I think downstairs outside on the terrace, that's great. And thank you so much for everyone who's dialed in remotely to watch on the internet.